Now let's assume that although BigNet buys Smallport on December 31st, each corporation remains a separate corporation. That means they do their own financial statements, but at year end, when we want to present our financial statements to outsiders or third parties, we have to make a combination to show that this is the combination of everything that we own. Smallport is simply an asset of ours. So let's assume that BigNet acquires Smallport on December 31st, the last day of the year, issues 26,000 shares of $10 common shares, par value common shares. They're valued at $100 per share, $2.6 million in total. BigNet pays $40,000 to a third party to assist in arranging the transaction. Then to settle a difference of opinion regarding Smallport's value, BigNet promises to pay an additional $83,200 to the former owners of Smallport's earnings if Smallport's earnings exceed $300,000 during the next annual period. Why the book put this in to make this more complicated, I don't know, but here it is, and we're just going to deal with it because I want you to be able to go back and use the book as a reference. Okay, so BigNet estimates that there's a 25% probability that they'll have to pay the $83,200. It's just another liability. It's another maybe payment that they'll have to make. Anyway, if this happens, what you do is you assign a discount rate to the amount that would have to be paid. In this case, the book chose 4%. 25%, that's the probability, of $83,200 is $20,800. Then you use present value tables to figure out the present value of $20,800 at 4% for one period, because it says the next annual period, and that comes out to be $20,000. All right, let's just go on. BigNet pays with this contingent liability and $26,000 of their own share. Now, the net assets, right, assets minus liabilities of Smallport, the fair value here, are $2.55 million. So BigNet paid $2.62 for $2.55 of identifiable assets, and therefore the excess is goodwill. In addition, they paid that $40,000, which to third parties, which we record as a period cost of an income statement item. So here's the numbers from your textbook. At acquisition, BigNet records an investment in Smallport, consideration given, or we record assets for what we pay. We have the contingent liability. We paid common stock and we paid additional paid-in capital. And then separately, that period cost, period expense, professional services expense, it could have been an accounting expense, it could have been legal expenses, it doesn't matter what you call it. And cash went out. Now what we want to do right after we do this acquisition is to prepare a single financial statement for the combined company. That's what a consolidated statement is. So we have to include for BigNet the results of any of these journal entries. Nothing happened to Smallport. All that happened with Smallport is BigNet gave their stock to the Smallport owner stock, and so this is everything that happened was from BigNet's point of view, not from Smallport's point of view. So BigNet recorded before this investment their beginning retained earnings, their net income, their dividends, and their net income of $200,000. So that was $960. Now we need to include what happened in this acquisition. So remember, there was another $40,000 paid out. So expenses went from $800 to $840 after the acquisition. So now we have retained earnings after the acquisition of $920 for BigNet. We want to combine these companies only to present to external users. The companies retain their financial statements just as they always did. This is just consolidation. It's not part of the company's journal entries or individual financial statements. So we want to do two things here. We want to eliminate the investment in Smallport because we own Smallport. It's part of our company. We're folding them together. And we want to show the assets at fair value, everything that we got when we bought this investment in Smallport. Again, these are for consolidation purposes only. I don't think that's on page 6. I just have a little error there. Let's fix that. Okay, so you'll see this in the worksheet. In these columns, a negative is a credit and a positive is a debit. Then we have consolidation entries. We have a little worksheet with debits and credits separate. And then our consolidated totals again are negatives or credits and positives or debits. Now, this is empty here because BigNet didn't own Smallport during the year, so all of Smallport's earnings and thus all of their retained earnings have nothing to do with BigNet until the acquisition takes place. And I did copy this down here again. That's what we're picking up. So if you look, we have, oh wait, not $1.1 million, but $1,060,000 because remember we had that $40,000 that we had as expenses up here. So when you put this together, you have to realize that you've included the journal entries for the acquisition. The acquisition took place sometime on December 31st. So what they showed you initially in the book and the examples was December 31st before the acquisition. And they maybe should have made that clear, but they maybe didn't either. That's why I'm doing the videos. Okay, so after the acquisition, our expenses went from $800 to $840, and our current assets went from 1.1 to 1.06. Okay, now we also now have an investment in Smallport. We made that journal entry of 2.62. We've issued additional common stock. We have additional paid in capital, and we have the retained earnings that have been changed because of these journal entries above. Okay, Smallport, same as it always was. Smallport is Smallport. All of that is the same. Now, we have to take into account two things. We want to get rid of the investment in Smallport. Yes, this is the order that they usually do this in. And A is we want to bring the assets, combined assets, to fair value at the date of acquisition. We bought this. These are the ones we need to bring to fair value. So we have two goals here. So we would do these journal entries. First, to eliminate the common stock, the additional paid in capital, and the retained earnings of the investee, Smallport. So these are all credits. If I want to get rid of a credit, I have to make a debit. So if I combine these two, 100 credit, 100 debit, I'm going to wind up with 0. That's my goal. And I'm going to use the balancing account investment in Smallport because my goal was to get rid of this investment. That was one of the two goals, that and bringing their assets to fair value at acquisition date. So I credit the $600,000 that I debited here for their equity. I know I'm still left with, in fact, $2,020,000. That's fine. So I got rid of, when they say eliminate equity, that's exactly what we're doing. We're eliminating all of the equity accounts for the investee company. And then I want to adjust their assets to fair value at the date of acquisition. Well, for example, their computers and equipment were $400,000 on their books and $600,000 is fair value. So they're $200,000 undervalued. So I need to bring this up to fair value, 400 plus 200. The capitalized software was 1.2. I need to bring that up to fair value. I need to include goodwill because we paid extra, or BigNet paid extra, $70,000 of excess payment is goodwill, so I include that. And even the notes payable were too low, so I included that. I brought that up. So instead of 200, I have a credit. Remember, that's a credit. This is a credit column, so 250 is 250. Once I get my S&A entries in, I just bring everything across like I would in any other worksheet. Well, since nothing's there, those all just go across. What happens here? I had $1,060,000 and $300, both debits, so I have a debit balance. I have investment. Here is a debit of 2.62. I made two credits for a total of 2.62. That's zero. That's exactly what I wanted. I've eliminated the investment in small port. For the assets, for example, I wanted to bring this up to its fair value at acquisition is 600, so 600 and 1.3 is 1.9. This was 1200 fair value, so 1200 and 500 is now 1.7, etc. We go across. Now, note payable, credit, credit, credit. Add them across. Now, common stock. Big nets, 1.86, and we've eliminated the common stock in small port, so we come to just the total numbers in big net, which is exactly as it should be because we've combined these. We've basically eliminated the equity and the investment in the investee or in small port. So what I have now is consolidated totals, which would allow me to very easily make my financial statements. I can do my revenues and expenses. Net income comes down to the statement of retained earnings. We're back to basic accounting. Retained earnings, beginning retained earnings plus net income minus dividends. My dividends are a debit because these are credits. This is equity. Gives me final combined retained earnings of 920. Ending retained earnings makes its move down to the balance sheet. I have only the retained earnings and the equity, the common stock, and the additional paid-in capital for the controlling company. And then it would be very easy to do a balance sheet. We've got current assets, cash, and whatever else. No company just does current assets. This is just to eliminate too many details so we can see what's going on. All of the assets listed, all of the liabilities, all two of them, and the equity. And that's it for this chapter.